for right now, I know we kind of do this every time, but we're kind of just going to do basic top-down analysis, kind of go through the whole thing, touch on kind of how you want to break down these charts when you're looking at things like this, so you can kind of understand like what certain things are going to happen. You can kind of not necessarily predict, but more or less just kind of understand how the market moves and what to look for. So first and foremost, we'll kind of look at GJ or GBP, JPY. Still going to go on stocks in a minute here, so stay with me. But with this, I know Andrew kind of just showed you guys liquidity grabs and stuff like that. On the daily chart on GBP, JPY, you can see that exact same thing happened right here. You had that buyer momentum initially to where you had buyers basically control the market in this area right here, push price to the upside, and then pull back down to a certain level. Once we got down to the bottom, and the thing that you have to understand with liquidity grabs is a lot of times they will look like double bottoms or double tops, but they could fail. And what I mean by that is a lot of times you could see it just double bottom without having that liquidity grab above or below the double bottom or double top. And so I'm not sure if Andrew touched on that, but you can see that example right here where price pushed to the upside. We had that high, which broke these previous two highs right here. It pulled down into this level down here to where we double bottomed. And most of the time with liquidity grabs, you would expect price to pull back down lower and grab liquidity down below this right here. But that didn't end up happening. It kind of just pushed price back up to the upside and topped out right here. And we got that consolidation zone from here to here. And once that happened, a lot of people came in short off of this candle right here, which I will just mark out right here, because that is a bearish engulfing candle. And so my blue candles, or these light blue candles, are all my bullish candles. Black is bearish. Let me hide the IB candles. Okay. So right here we had that consolidation zone. So most of the time retail traders are going to come in and see that and think, okay, well, the market's stopping out this bullish momentum to the upside, and we should enter a short off of either a bullish engulfing or some sort of other lower time frame confirmation candle. So with this, it came in right here. We had that bullish or the bearish engulfing, and it pushed price to the downside. But one thing that would have triggered me in knowing that the price was going to push back up to the upside is off of this second candle right here, because off of this, typically after a bullish or a bearish engulfing candle, you're going to have a secondary candle that will push price past that and lower, or push price further up to the upside if it was a bullish engulfing. But with this candle, we topped out to the bottom, and it actually ended up not breaking any lows in the market and actually pushed back up to the upside off of this. As you can see right here, we had initially this low, but price stayed above that low and didn't push lower. The one thing that you would understand with price action, or knowing that the trend is going to change off of something like this, is if we broke that market structure right here and pushed down below that, then you would expect price to continue down lower. But in this case, we stopped out right here, got this candle right here that didn't really signify any direction really. It just kind of signified that price had stopped. But for people that trade the way I trade, or the way Andrew trades, or trades the institutional method, you can see something like this and understand that price is likely going to push back up to the upside before it grabs that liquidity up above and then shorts again. So if we scroll out, you can see that's exactly what happened here. Price pushed up right here, pulled back down, double bottomed, pushed back up to the upside, halted out right here, or consolidated, ranged, whatever you want to call it. Came down in here. We had that secondary weak candle after a bearish engulfing. Price ripped back up to the upside. You could consider this a bear or a bullish fake out. So a lot of times people will see that it broke the structure, or this broke the highs, and think once they get down to this retest level, they would want to enter a long. But most of the time when you have a market like this, to where overall we've had pretty strong bearish momentum downward, multiple times actually, and specifically with this uptrend right here, we pulled back down to about the 786 level of the Fibonacci retracement, meaning that price recovered 88% of the previous up move. So when you have something like that, you would overall expect the market to be a little bit more bearish than bullish in this case. And so we had that push to the upside, strong pullback down, retrace back up to the upside, grab that liquidity up above, and then retrace back down, and had about almost 900 pips down to the downside if you would have gotten in off that liquidity grab. Essentially, liquidity grabs are, if Andrew didn't already explain it, is more or less just the way it works is banks will come in and see that retail traders, when they have a double top like this, or obviously we had that double bottom, so most of the time retail traders will think once we double top, we would want to enter a short position in a ranging market. So what they do is they come in and they end up buying up as much as they can. So they'll come in off of something like this where it double tops, and once the retail traders come in and short the market, they'll buy up as much as they can to push price back up to the upside. And once that happens and everyone's stop losses are taken out up here, then 9 times out of 10 they'll re-enter their short position. And at this point right here in the market, after they've recovered those buy positions about right here, then they would scale into their position off of a break like this. So let's say we will drop down to something like the 4-hour chart here, scale over here. So in this case, you'd come in here, obviously it kind of stopped down here, consolidated, whatever it may be, pushed back up to the upside, pushed down, broke that previous low. Most of the time what they'll do is they'll close their long positions when they reach back down into equilibrium, whatever it may be, where the price just kind of equals out their buy position. They'll close those long positions off of this retest of the low. So price broke down below the low, pushed back to the upside, retested that low, and then they would scale into their short position and grab all of this all the way down. One thing I will say because I know I saw someone post, how do you know when to enter a market and stuff like that? More or less, you just want to understand candles themselves. Myself and Andrew will likely be putting together that Forex guide for you guys this week as far as price action goes and stuff of that nature. And so with that, we'll kind of touch on candlesticks themselves. My whole background is basically just candlesticks. What I focus on when I trade is not necessarily patterns or market structure itself. I look for candles and see what candles look good to me to enter off of either buy or sell positions. And so in this case, when you have something like this where price came down, we got that consolidation in here, pulled down into this level, got that consolidation and pushed back up to the upside. What I would probably have looked for is probably a rejection candle or price weakening out to the downside, which would have been likely off of, let's say, this candle right here. The reason being, it's what's considered a spinning top, meaning that the body of the candle is about equal to the lengths of the wicks of the candle. So price, most of the time, not always, I know people get frustrated with hearing most of the time or likely, whatever it may be, because we're not wizards. We can't just predict the market. We don't know what's going to happen. Even though the candles may tell us one thing or the structure of the market may tell us one thing, something could happen to where either news comes out or something comes out to where it can completely change the dynamic of the market and switch everything around. And that's the same with Forex, stocks, crypto. It happens in every single market, futures, whatever it may be. So with this, we got that spinning top candle, and a lot of times that can serve as a point of reversal in the market, especially after something like this, to where we've kind of got this bouncing in the market, push to the downside, and then phased out down here. Price will push back up to the upside, and then in this case, I wouldn't have shorted up here because it's most of the time pretty impossible unless you were like on like a 5-minute chart to get into a market right here without looking at a break of structure. I mean, you could have looked at something where we had this kind of weakening of price down here in this area and hopped in off of this retest of that low. But a lot of times that can fail depending on the market. Obviously, this is all back testing right now, so it's easy to see where it would have reversed in the market previously. But when you're looking at the market at the time, this thick candle right here could have faked out, and you could have thought it was going bullish, entered buys, and then gone from there. But a lot of times, like I said, it'll break down, push back up, enter a sell position, and grab all of this too. But really what banks do, or what more experienced traders will end up doing, is off of this low right here, they'll come in and they'll buy or they'll sell off of this retest level. And if the market was flipped, obviously we'd buy off of a retest as well. But that's kind of the way you'd want to look at a break and retest of structure, is breaks below the low, pushes back up to retest the low, and then sell off of that position. And obviously if you'd done that off of something like this candle right here specifically, this would have been a good candle to enter off of, because I've touched on it before in lessons we've done previously, but it's what's considered a spring bar candle, and you can do it either to the upside or the downside. Sometimes it fails, sometimes it doesn't. Like I said, we're not wizards, we can't predict the market, but if you would have entered off something like that, you could have grabbed this whole position to the downside and had a really nice winner off of that, and potentially even held down till it reached this previous low down here, which would have been the low back around the July. Obviously this is off of a 4-hour chart, so it's a little bit harder to base things off of unless you're swing trading. But for day trading and stuff like that, you want to look at something like a 4-hour chart to determine market structure, and then enter off of something like a 15 or a 5-minute. This was something I think I posted for you guys last week as far as imbalances go. And I've talked on imbalances before, but right now you can see with GJ, it pulled down into that imbalance, which correlates with this 50% level of the institutional candle right here. So that's something I kind of touched in on the lesson last week when I was doing the live session for everyone, is when you get these institutional candles, and this works for both Forex and stocks too, just so you guys know, when you get something like this where you have this big candle right here, price has to always recover that position, because you can never have one side of the market that's way too bullish or bearish. Obviously you have those stocks like Neo and Nikola and all those other shit companies that come in and they just run to the upside like crazy and don't stop. That would fail. Something like this would end up failing, obviously, because it's not going to pull back into it. But where with Forex, crypto, futures, where it's such a liquid market, most of this would tend to work in that case, because price is always continuously moving, almost 24 hours a day, about 7 days a week, with Forex and futures excluded. But with this, when you have that imbalance right there, you can see price push back up to the upside, pulled back down into this level down here, which was the 382, consolidated in this range, and then these previous lows right here, price broke down below that, grabbed liquidity down here in this imbalance range, and then pushed back up to the upside. So that's one way you can kind of pair the different methods together, is by looking at market structure. And obviously this would have been taken on a lower time frame, but in this case you had this liquidity level down here to where price had held these lows, busted below that, touched that 50% level, and then pushed back up to the upside. One thing you always want to make sure you're doing is looking for confluence. And so whether that be you have indicators that indicate your overall thoughts, as well as looking at price action at the same time. So in this case, seeing that the 50 exponential moving average crossed above the 200 exponential moving average, I would know that the market is overall bullish, because it's not trying to push back down, and we're still pretty decently wide between the two. So overall the market structure right now is bullish. So that's one thing you can kind of always touch on, is whether it's stocks or Forex, you always I would tend to say the 50 and the 200 EMA are key in looking at confluence in the market, because they basically just take the price of the last 50 candles, whether that be the hour, 15-minute, 4-hour, whatever it be. It's the last 50 candles average price is what they use to tell you kind of the story of the market. So in this case, when the 50 EMA crosses above the 200 EMA, market structure is likely to be bullish, and if it crosses below, it's likely to be bearish. You do have instances like this where it failed to break above and continue down lower, but if we have something like this where it gaps up above so far, most of the time it's going to take a while for it to cross back below, and so overall the market structure will be bullish. So on this trade, you have so much confluence as far as knowing that there's liquidity below this level, there's an imbalance because of this candle, we have the imbalance level of the 50% of this institutional candle, and then we also overall are bullish right now. We would know that the market structure would pull back into this level and then long off of that position. This wasn't a trade I took because I don't really like trading GJ, but it's something you can kind of just look out for when you're trading, whether, like I said, it's stocks or Forex. And even in this case, the 50% fib level also lined up with the 50 fib from the low to the high right here. And so that's another confluence you can look for, is the fact that there was a 50% level at the same 50% level of the imbalance as there was from the low to the high. So that's one thing. I know Sensational asked about like the fib levels and stuff like that we touched on. More or less, that's kind of just what we went over, was looking at something like this. But yeah, that with Fibonacci levels, I personally only use the 382, 618, and the 50 fib levels, because I think anything past that, most of the time, is going to have price fail it. And I know the few guys that were under the same mentor program as me can conclude that the 786 and the 886 level doesn't really work. I hate to say it, but it really doesn't. I've backtested this for over a month now, and the 786, the 236, this 78, whatever the hell it is, those levels aren't going to work 9 times out of 10. The 886 is a little bit more key because it lines up with the harmonic patterns, but 9 times out of 10 it's going to fail. And so I don't typically use harmonic patterns anymore. I spent 9 months learning them, and it's not done me a damn thing. So with this, I think this method that I'm kind of going to be teaching you guys is going to be 90% more effective than harmonics, flag patterns, any other pattern really. The only thing I really trade off of is trend lines. I use trend lines to overall mark out the structure of the market, so I can determine whether I'm going to go off of buy positions off of that area right here. Because if you look at something like this, where price came down to this trend line, touched it again, came back up, right where it touched it again the second time at that imbalance level, you could have bought off of that, which once again is more confluence. You could have bought off of that level and taken this whole ride all the way to the upside, which would have been 234 pips, which on GJ is huge, because with GJ you have to have quite a bit of leverage and margin in order to actually trade the GBP pairs. So for most accounts, like let's say, like I said, I started that $500 account challenge today. And with that being said, in this case, GJ and GBP USD, I wouldn't trade a 0.10 lot size off of, because the leverage and the margin can be a little sketchy on that. So if it reverses to the downside or the upside fast, it can tend to stop me out a little bit quicker, because the spread's not higher, but obviously like right here you can see spread on GJ is 2.7, but if I look at something like USD CAD, it's only 1.8. So there's a whole pip difference in spread right there that would give me a more effective area to buy in or sell off of, and I could get a better entry price off of a lower time frame, like the 5-minute or the 15-minute, when compared to GJ or GBP USD that have a little bit higher spread. So in this case, I would stick with pairs that aren't necessarily associated with the GBP, unless it was something like Euro GBP. This pair I like to trade a lot, but right now it's kind of nothing too crazy, so I don't really like the market right now on Euro GBP. Real quick, I'll kind of just touch on that whole method I said I was going to show you guys on, which was the basis behind my whole Euro JPY trade. And then we'll get into some stocks, and I'll show you guys how it correlates with that, and get on more technical analysis with stocks. So this trade, I'll kind of delete this so you guys can look back on it. This is what's called the ICT ATM method. Not something I invented or came up with. It's something I learned. And basically it's taught by a guy that goes by Inner Circle Trader. He's a straight Forex broker or a Forex guy. And this is a method that he kind of teaches, and this works both conversely with Forex, stocks, crypto, futures, whatever it may be. Essentially it's a break and retest in the market, but it has a little bit more than just like break and retest levels and stuff like that. So with this trade, essentially I'll kind of just walk you guys through how it works, and I'll delete all this so I can walk you through it. Let me see. We'll do a replay. I think it was like right here is when I was looking at the market. So basically what you want to look for something like this, and I know those lines kind of might confuse some of you, but essentially what you're looking for in the market is areas where price pulls back from and then breaks lows and breaks highs, meaning that we create lower lows and then eventually create higher highs. This is something that I know Elliott wave theory kind of touches on and goes over and that sort of thing, but this is something that you don't necessarily need to learn Elliott wave theory to understand. So in this case, what I was looking at here was right now, obviously most people would think, okay, let's take a short off of a position like this, where we had multiple rejections of candles, market consolidated up here and kind of completed this supply zone up here. Most people would probably take short positions off this and try to ride it down below these previous lows down here. But what I was looking for was something where basically the market structure you want to look for is something where I have no clue what just happened. Did that just pop? Oh, okay, there we go. That was weird. Okay. So with something like this, yeah, sorry guys, I don't know what just happened with that. That was weird. Essentially what you want to look for is where price comes down into here, pulls back up to the upside, pushes back down lower, and then pulls back up to these previous lows right here. So with this case, like I said, it's going to be something you guys want to back test for a while on stocks, Forex, everything. It's not going to be something you're just going to identify right away and be able to trade off of, because there's a little bit more involved with it than just looking at these type of structural moves. But essentially with this, we broke down to the downside, pulled back up, and if I pull out the Fibonacci, let's see where it is. I think it's a 382. Yep. Pulled back into the 382 level. So you can use Fibonacci's to kind of understand all of this, but pulled back down. We broke down below market structure. We cleared this low down here, and then we pulled back into this previous low before shorting again. Obviously, this wasn't something I was looking at previously, but we pulled down into this level. And what you want to look for, this is the whole key piece to this whole move right here. So we have that breakdown, push up, breakdown, push up into this low, pulled back down. And right now, what we want to see is we want to see price break above this before we can look at more buy positions or where the market's going to move on from here. So with this right here, I'll move that over. We have this high right here. We have this other high right here. Right now you can see that the 50 EMA and the 200 EMA are squeezing, meaning that the 50 EMA is likely to cross back above before we would probably want to look for buy positions. So in this case, we'll scroll forward. Let's see, where was it? Oh, sorry guys, I missed, wrong piece, sorry. It was this low right here. This was what I was looking at, not the other one. This was the low right here. So once we made this low, this was what I was looking for. So price came down into this low down here. This was the previous low, the previous highest low. So this was where I was looking for it to break structure off of. And you can see right now, price came, we pushed back up to the upside and broke back down pretty sharply. But overall, we broke back above that structure because this was the previous lowest high. And so once we broke above that, I knew that price was likely going to recover that position and push back above, which you can see right here. Right after we had that break of structure, we pushed back down below. We broke back up to the upside right here, and price started consolidating in this range right here. And so overall, we probably were going to push back down. Likely we were going to push back down a little bit, but nothing that would have shaken me out. And so what I was looking for was a buy position off of this area. And that's, I entered about right here. There you go. I entered off of here, put my highs at the previous high. So I was looking for something that would pull back into this level because previously we had this high over here, this high right here. So I was looking for price to go back up into that level. And then I placed my low back below the previous low. So right now the risk to reward really wasn't that good, but this was something I learned off of, and something that I'm going to be posting in the the learned lessons or whatever it was. This is something I'm going to be posting there and kind of like why this didn't work, but I'll tell you guys why. Because essentially we had this imbalance in price right here. Now you guys can't really see it, but we had this imbalance right here. And we also, one thing I'll tell you guys with Forex, 9 times out of 10, actually I'd probably say 99% of the time, with the London session, meaning that it's going to be 3 a.m. Eastern time or 1 a.m. for me. With the London session, 99% of the time, price is going to break back below this daily open level or this weekly open level before longing again. So really what I should have looked for was long positions off of this imbalance level, which worked in conjunction with the daily open level, and I would have had a better risk to reward ratio. But I was just going off of this level right here because one, we rejected the 50 EMA, price was squeezing, we were accumulating right here, we had that big bullish candle, and I want to say this was off of the 382 level that we were rejecting off of, and more or less we were rejecting with just the wicks themselves. Really what you'd want to look for is something down in this 50 level, because like I said, the 50 level is key because price will, whether it's stocks or Forex, is always going to recover about 50% of price before looking for buys or sells. So if overall market structure is bearish, we would want it to retrace to the 50 level. If it was bullish, we'd want to retrace to the 50 again. So in this case, we'll mark that out. And it kind of started working out in my favor. We got that big run to the upside off of this buy. In reality, I probably should have sold once it reached this level because we rejected pretty strongly off of that level right there, which was another previous high. And so really I probably should have sold off at least most of my position up here, or at least close my position, which would have been about, I think it was like 20% gain from the $500 account. So it would have been a pretty decent win off of that. But you can see right after, price just took a shit and went straight down to the downside. And eventually when I had that move back up to the upside, I actually ended up moving my stop loss level just below the daily open, which I kind of goofed on. And that was one thing I I'm going to post in that testimonials or whatever channel it is. With that, I kind of screwed myself on this because I completely spaced that with the London session, price will always recover back below this daily open level before pushing back up to the upside. And so I should have left my stop loss back at least below these lows, if anything else, not maybe below this, but at least below these previous lows, because then I wouldn't have been stopped out. But in this case, that's just kind of something I learned on, and something I need to focus more on when I'm opening these positions, is making sure I'm not keeping it too tight below these daily open levels during the London session, because price will always tank below it and then recover and go back in your bias direction once you kind of understand price action and stuff. But I mean, obviously you can see right here, I would have slammed my take profit within a few candles right after that if I'd not been stopped out. Like I said, I had it way too close and ended up getting stopped out right in here. Luckily, it wasn't anything bad. It was only like what was that? Five pips. So it wasn't really anything bad for stop loss level, but it still sucked to get tagged out on because I was overall bullish on this market off of this pattern. And so in this case, something like this, you just want to overall look for something like this where you can see price come off of a high. So after a bull run like this, with this kind of market structure, you want to see a big bull run like this, price kind of do this whole move right here where you really want to get two previous lower highs and two previous lower lows before looking for buy positions and a break of structure. So in this case, with this pattern, we broke down below, pulled back, broke down, pulled back, and it actually gave me one more before it pulled back up into this, and this was the previous lowest high. Price pulled down into this, reached that same level that we previously had, and so when we have that kind of lower high right here or a double top off of this level over here, then we'd want to look for it to touch again. Obviously it did, broke market structure, pushed above, accumulated right here or ranged right here, and then overall push back in our bias direction. But with something like this pattern, whether it's stocks or Forex, you want to see price pull back into a certain Fibonacci level, whether that be the 50 or the 382, before you want to long off of something like this. Really, I should have looked for the 50 level rather than the 382, but and more or less that's just because we had this imbalance. But with this, it should have been something I was paying attention to, but it was late in the night, wasn't paying attention, and honestly it happens. So that's one thing a lot of new traders will kind of fail to understand is stops happen, stop losses happen. I know a lot of people, myself included, I don't always use stop losses, but when I have overnight trades, I always keep a stop loss on. If it's during the day, I usually won't have a stop loss because I've just gotten enough confidence in my trading ability to where I don't necessarily need stop losses, and I can tell where price is going to react off of certain levels and push off of. But for the most part, new traders, you should always be using stop losses. I don't tend to, just because I've gotten enough confidence in my trading ability now to where I don't necessarily use them as much. In this case, obviously I did get stopped out, but it was because I moved it before I went to bed. And so in that case, reality should have been stopped, have my stop loss down here, not so high up, and wouldn't have been stopped out on. But that's kind of one thing I will say. Like I said, this was the basis behind my the AUD JPY trade last week. This was the basis behind this trade. This worked out in Euro USD last week too. It was something, I know I was shorting Euro USD last week, but this was something I should have noticed and wasn't really paying attention about. And this did the exact same thing on Euro USD before it had that big bull run right before Friday. So this was something I wish I'd paid attention to and seen previously, but didn't end up seeing that, and it stopped me out on Euro USD. But in this case, just look for something like this where we have a break, a retest of a certain key Fibonacci level, break down again, create that lower low, pull back into the previous low, and then once again we get this kind of consolidation range to where we want to wait for price to break this previous low and pull back into it, or at least pull back into a certain Fibonacci level before we'd want to long again, which obviously that's exactly what happened in this case. So like I said, this works with stocks, Forex. It doesn't really matter what you guys are trading. It works on any time frame. And really, obviously, in this case, market structure right now is pretty bearish on Euro JPY, but this is something you don't necessarily need the overall trend to work out for you. Obviously, you want to backtest it yourself and kind of get a feel for it to see how it works for your trading style. But in this case, it's been something I've been back, like I said, about 2 weeks now. I've been backtesting this about every day, and it seems to work without fail for the most part. So that's just one thing I'll say with you guys. Like I said, with this trade, we'll just exit out of it. This trade, it ran 75 pips up in the upper direction. So, I mean, in reality, I could have looked for something off of one of these levels up here, like maybe something in here, off of the previous lows over here for my target area. But I was just playing it safe and just hoping for a run to the upside right here. I'll say it was about 30 pips up here right here that I was looking for, because 30 pips off of a $500 account, I mean, you can't beat it. That's pretty good gains off of that. But now we can touch on some stocks and get over to there. I know you guys kind of all saw the ordeal with Option Daddy today, so I'll kind of touch on that and why he got screwed today. So, imbalances work with stocks and Forex. It works a little bit differently in stocks when compared to Forex. Really, you just want to look for gaps in price. So I know a lot of people play gap fills and stuff like that, but really it's the same thing as an imbalance of price. With Forex, it's just shown a little bit differently because the market closes for stocks. So with Forex, you'd see continuous candles to where you wouldn't have these gaps in price, but in reality, it's the same thing as if we had a big institutional candle that ran to the upside where this gap in price is. So once again, 99% of the time, gap fills will always happen at least to a 50% level or for the full recovery. And you can see that exactly happened with Apple right now. So with this, you can see we had a gap in price right here. Price broke down to the downside, recovered back into this position, but in reality, it didn't break this high. So with something like Apple, in this case right now, we had this previous break of the low, have this gap in price right here. There's 3 tabs open, Beanie. With this gap in price right here, we had a breakdown to the downside. We filled this gap right here, which I can mark out like this. Ooh. So we had that gap in price right here to where price recovered back into it. And one way you could have shorted this market is off of something like this, because you can see right now we have that 200 EMA, which if you don't know, EMAs can also act as resistance or support. And so in this case, we had that happen with the 200 EMA. So right here, we had this high, we had this gap in price. So price right now is bearish, broke down through the low, pushed down lower, and pushed back up to the upside to fill that imbalance in price right here. Once that happened, overnight, right before market closed, on this hourly candle, we had this, there's like 50,000 different names for it, but whatever. I'm not responding to that, Beanie. In this case right here, we have this kind of doji candle or shooting star or whatever you want to call it. This kind of signifies that price is more bearish than bullish because, one, we closed the candle bearish. The wick of the candle is longer than the body, but the body for the most part is about a fourth of the actual wick itself, showing that there's still buyers in here, but for the most part, the bears control the market. And in this case, you'd want to look for confluence. Like right now, you can see we had that wick rejection. The body didn't necessarily close too much above that 200 EMA to signify that it was more bullish than bearish. And so you could have entered puts off of this right here and rode this whole thing down to the downside, down into this right here. Obviously, you wouldn't know if you're going to catch a big move like this because obviously that's a huge candle. But let's say, I mean, you could have targeted something like this to this other little candle right here, because this was a area of structure, meaning that this was an area where price pushed off of and closed above the previous high of this long candle and pushed back above. You could have targeted down into something like this overnight and had like a take profit position. Obviously, options are a little bit different, so they don't really have take profit, but they have more like take profit areas you'd want to mark out. But in this case, price broke below this previous market structure. Once again, you can see we pushed below, filled this, we have this big gap in price, pushed below, had a new low in price, broke above, rejected this high. We could have entered puts off of this. Market overnight broke down below, but right before market open, you can see that it retested that low before you could have entered in puts again. So you can see right here, it did the exact same thing in stocks that it would in Forex, where we have a gap in price, break of the low, retest of the low, and we just got botted. So I think that's cool. So that's cool. Anyways, break of the low, push down to the downside, retested this. Obviously, you couldn't have entered off of something like this because this would have been in the pre-market hours, and I don't think you can. 90% sure you can't trade options during pre-market. So in this case, we pulled back up in this, but in reality, you could have entered puts off of this and at least rode this short little wave to the downside. In this case, obviously, right now, same thing once again. Price recovered this imbalance right here, and I highly recommend you guys, if you're using TradingView, I highly recommend having the pre-market hours and the aftermarket hours in your charts, because it'll help a ton with gap fills and stuff like that. In this case, broke to the downside, recovered this gap right here, broke again, broke this low. But one thing I'll touch on is we didn't break that much lower than the previous low. So right now you can see this is a low and this is low. So one thing with the mentor I had, he kind of teaches on what's called projection. And really that just means the length of time between where you have these short positions and stuff like that. And this works in both Forex and stocks, crypto, whatever it may be. In this case, we had this big gap right here from the previous low to the next low. But in this case, we had a shorter low to where price really didn't make price that much lower than this previous low. And we kind of started faltering out right here. In this case, same thing happened right here, to where really we got a little bit weaker in price, to where it didn't really push much lower than the previous low. And so when you have something like this where it just kind of gets weaker and weaker as price goes down, and you don't get much lower lows, I should say, then off something like this, you could expect a reversal incoming. Obviously, it'd be hard to determine when the reversal was incoming, but in this case, you can see it did come. We had this gap in price. Pre-market hours filled that gap with this wick, and then once that happened, we were overall bullish again. So overall, right now, that's kind of the segmentation of the market for this. I think it was October. Yeah. This was their last earnings too, so that kind of affected this big institutional candle. But in this case, with kind of what happened with Option Daddy today, right now, we never got that imbalance fill right here. So you can see, obviously, I think this was over the weekend. I think this was a weekend play right here. Actually, no, just kidding. No, this was just a daily. I think this was like Monday, Tuesday. But in reality, we never recovered this gap position right here. And so you can see, if you kind of go through your charts, you can see 9 times out of 10, you'll see price recover those gaps or those imbalances in price. You can see it happen continuously leading up to this point. But right now, when we had this right here, once again, we can mark out our lows. Low right here, low right here, and the highs didn't really get much higher. Lower high, lower high, lower high, and price just kind of started pushing back down to the downside. But obviously when we were pushing back down to the downside, we weren't getting that, or that we were getting a wider spread in the short or the lower highs. So when that happens, like I said, in that bullish scenario, you can expect a reversal incoming. Obviously this was already in a downtrend, and so in this case we had this weakening of price right here where it just kind of started pushing down but getting wider as it pushed down. And then in this case we had this low right here. The reason I mark it out with this is because most of the time you'd see people put it down here, but the way I trade is I use off of the candles themselves. And so in this case, we had more candles reject off of this level than off of this one candle. So if we had more wicks or more candles down in this area down here, then I probably would have looked for something down here. But in this case, we had more bodies and more candles up in this area. So this was a more accurate lowest low. In this case, obviously, market broke below, and we'll consider the weekend obviously, but because obviously it's Monday. In this case, once we broke that low with this big bearish engulfing candle, or this big bearish candle in general, then because it closed below the low of these wicks right here, we would expect price to continue down, and that's exactly what happened. In this case, like let's say we go back to here, once again you can see those EMAs are tightening up and they're starting to close back below. And so if we scroll forward, oh, that didn't work. Anyways, if we look right here, price started closing down below, the 50 EMA started crossing back below the 200, and overall right now I would expect tomorrow to be pretty bearish on Apple, unless obviously right now we kind of have this gap in price right here from this big candle. So we could pull back into this level, pull back into the 50% level, maybe, and then obviously we still want to recover this imbalance, because right now we have to recover this position. I don't care what anyone says. I don't care how you learn about imbalances, how you learn about gap fills. This will always fill, no matter how long. It's going to take a while, obviously, in this case, because it moves so much higher to the upside. But eventually this imbalance will be filled, and it'll push back down to this level, and you'd want to look for longs off of this. Obviously, it could fail. It could go lower. We could push back down into this monthly open level and maybe look for buys off of that, because we have more structure in the market down here than in this area. But overall right now, this is the area we'd want to look for longs, because it has to recover this position before we can get really off of large buy positions in the market. So that's kind of one thing I'll touch on with the stock side of things, is really you want to look for gaps in price and trade those. Honestly, I mean, it's pretty simple for the most part, but it's a pretty effective method to kind of watch out for, is just looking for gaps in price, because like I said, whether it's stocks or Forex, you're always going to have imbalances in price. With stocks, it's a little bit easier to recognize when you have extended hours, because you can see these gaps up overnight. But in Forex, you more or less just want to watch for candles themselves. And so with the candles, you can watch more for like wicks themselves and see how wicks react to certain levels. Most of the time with Forex, you kind of just see where like the body of the candle. So I'll kind of mark it out, like, let's say this is the body of a bullish candle. Most of the time you'll just see the wick of the next candle pull back down at least 50% before you'd want to long off of like a bullish continuation. or like let's say if it's a bearish candle, you'll see something where price would recover to the downside like 50% like this, and then obviously we'd want the position to continue bearish or get like another bearish candle or something like that to where price would be reacting back down to the downside. I know there's people talk about different ways. You hear about wick fills and stuff like that, which I'll touch on in a later video, but more or less it's just kind of the way you want to look at things, and a pretty in-depth lesson on price action, but more or less it's kind of something that's more advanced that a lot of traders don't understand, because you'll see a lot of people just say, oh, it needs a gap fill, but they won't tell you why it needs a gap fill, and they won't explain to you, you know, when you have something like this to where you had this previous gap fill where it broke down to the downside, it retested again, and you could have shorted off of that. Obviously, this was an earnings play, so it would have been pretty risky, but overall, you could have bought puts off of this and shorted down to this, which would have been, let's see, if we shorted off of that candle, an 8% drop in the overall stock price. So an 8% drop in the overall stock price would have been huge for puts. Depending if it was obviously in the money or out of the money, but in this case, it would have been something that was probably look for something out of the money just because they're cheaper. So it's less risky, but in this case, 8% off of the overall stock price would have been a huge drop. So yeah, that's kind of, like I said, just more intro to price action, kind of going over things like this. If you guys want me to go over other stocks and stuff like that, go ahead and post them in the Forex chat. I know we're not supposed to technically use that for it, but post them in the Forex chat and I'll break them down for you, and we can look at other examples on this certain thing so you guys can kind of understand that. We'll kind of back test it a little bit more. LMT. I don't think I've ever heard of that. Oh, Lockheed Martin. Okay. I didn't know that was the symbol for it. All right. So what do we see here? Right now, obviously this is off an hourly chart. I know most people don't swing trade options as much, but in this case, I'm just using an hourly chart to kind of break down the overall structure. Right now, gap. Well, let's see. We have a gap right here. What happened? Price pulled back down, pushed back up. Obviously, we traded above it, but it still pushed back down below. This would have been something that's kind of a little bit riskier because Lockheed Martin's a pretty big company. But in this case, right now, we still have a gap in price right here, which aligns with that monthly open level. So right now, I would expect this to be pretty bearish for the most part, in all honesty, just based on the fact that we still have this overall structure down here that needs to be filled. Obviously, we still are making these lower highs, but right now, we broke below these lows. So in this case right now, we were pushing back to the upside. We had this pretty high right here. We rejected off of that, obviously pushed lower, kind of pushed back down to the downside. But overall, we kind of got this bounce in right here. And eventually, price broke back below. And once again, obviously, recovered that gap before it sold off the other day. I think this was Friday. Yeah. So in this case, you could have bought puts off on Thursday once we recovered that position before market close. And if you bought puts off that would have been a pretty massive gain. In this case right now, we have this gap in price right now. It still needs a little bit of recovery because we didn't fill the entire gap in price. So right now, we still have a little bit of a gap right here that could be recovered. We have that 50 EMA squeezing into the 200 EMA. But one thing with these is you could see it pull back into this reject off of the 200 EMA and push higher. So right now, even though we are making lower lows right now overall, we could still see it stop out above this and push a little bit higher before dropping down to fill this imbalance. Reason being, we still haven't broken this overall market structure right here. Actually, let's do this because I just noticed something in this price. So, where was it? Okay. Obviously, this is a little bit harder with stocks. Like I said, that method I kind of showed you guys, a little bit harder. In this case, what do we see? Pull to the low, push to recover, push to the low, pulled above, push below. Overall, we broke this low, right? What happened after that? Price broke to the upside, super strong, pulled back down to fill this gap in price, right at that 50% level. Let's see, where was it? It was right here. No, it wasn't that one. Anyways, regardless of that. But we pulled back into this, recovered that position, and if you enter off of calls off of this, obviously you could have profited pretty nicely off of that. We tapped again, came back into the same level for the most part before. Obviously you could have longed again. Because overall, when you have a big bullish run like this, it's more of a continuation in price because obviously we have this humongous gap between these two right here, but that just means there's more buyers in this side of the market than there were sell positions. Obviously, we sold off down into this level, but for the most part, there was more bulls in the market than there were bears. So let's see. I think it was right here. Where would that have been? Anyways, I'm not going to touch on the fib levels right now, but basically same thing. Pulled the low, made a higher low right here. We broke the overall lowest high and ran to the upside. So overall, you could have obviously bought calls off of this level. I mean, you could have bought calls off after it broke above this, but that would have been a little bit sketchier because it could have tanked back down to the downside, and you wouldn't have known really what happened with that. So like I said, this is something you want to use in conjunction with other things. You don't want to just blindly trade off of this pattern. You want to use other things that will help kind of guide you in the right direction. But in this case, obviously, market was overall bullish. We still had right here where we could have entered off of buy positions because this trend line overall was keeping the market afloat. So right now, we had this bearish fake out to the downside, still kept that position in the buys, and then if you bought buys or calls off of this, I mean, that would have taken a few days, but it would have been a $17 increase in price and about a 5% increase overall. So if you got calls off that, that would have been nice. Right now, we're making these lower lows, lower highs, and overall pushing back down to recover this imbalance in price down here. But that's kind of like I said, it's something I just kind of look for when I'm looking through these trades and going over things. But obviously, it's something you want to back test to see, is it something that's going to work for me? Is it something that works for my overall bias in trading? Because you want to see something that works for you specifically and not just blindly trade off of others. I find, a lot of people will buy into alert channels and stuff like that, which are fantastic for the most part. In all honesty, like I have nothing against alert channels, but for me personally, I would rather buy into something that maybe gives both alerts and teaches you how to trade on your own, because once you know how to trade and why trades are being taken, then overall you're better at what your overall marketability in trading is going to be a lot better, because you understand why certain moves are happening, but you can also obviously take calls because there may be a few ticker symbols or a few Forex pairs that you didn't necessarily look at previously, and someone maybe calls them out or posts them, and you can back test it and be like, okay, well, this person is taking this trade because of this reason. I can see why they want to either enter into buys or sells, because I can see, the chart breaks it down this way and this reason. But for the most part, I think it's tough to just buy into signal channels, because blindly trading can be the death of your account. And so learning how to read price action, learning how to read these charts is going to be humongous in your trading, and it's going to help you overall in the future. But yeah, let's end the overall price action lesson with that. If Andrew wants to go over some more crypto, he can, or we can just have you guys ask some questions. And obviously, if you have more ticker symbols or Forex pairs you want me to look at, just let me know and we can go over those. But let's just kind of end the price action lesson there, and then have you guys ask some questions and stuff like that.
Yep, I don't got anything I really need to go over still, so
Okay.
just answer questions.
Okay, PayPal. I'll do the PayPal for you real quick, Beanie. Let's go to the hourly. Ooh, this is a tough one. So we have this institutional candle. Yeah, I don't know about this one. This one's, to me, is kind of a hard chart to read. I mean, we have a harmonic pattern, which obviously, I said I don't really trade these anymore, guys. But I know, like, Andrew sometimes uses them. Sensational uses them, stuff like that. But let's see, this would be an 886. I guess puts wouldn't be bad on PayPal, honestly. We recovered that imbalance in this institutional candle right here, and this pattern shows that overall pretty bearish. I don't know. It's hard to tell. This chart's kind of sloppy to me. We've kind of just been ranging the last little while. We just kind of been bouncing in between, so this one's a little bit harder to trade on a higher time frame. Obviously, on a lower time frame, it could tell a different story, but I mean, right now it's kind of showing me a little bit more as far as sell positions go. Being I can read market profile, I just prefer reading off of the actual charts, because the charts tell the same thing market profile tells you. Candles themselves can tell you what market profile tells you. Yeah, I would say this is probably a little bit more bearish. The reason being, we had this massive drop to the downside, equally recovered almost to this exact same extent on this side, and recovered this imbalance in price. And then right now, this isn't a very strong move to the upside. So one thing we kind of touched on in the lesson last week, the kind of live lesson I worked on last week with a few of you guys, was it weakening of moves to the upside. So in this case, I mean, I'm not going to use their actual terms because I think they're copyrighted. I don't know if Trader Talks copyright them or not, but in this case, we had these moves to the upside, but in reality, it wasn't something that usually you'd want to look for. Obviously, strong buy positions are when price moves like this and has these sharp moves to the upside like that. That's when you know that the market is more or less bullish to the upside. But in this case, we weren't really getting that move like that to the upside. We had a super weak move to the upside before a pullback, and then this kind of weak angle right here back again to the upside. And so in this case, puts would be a little bit more profitable in my opinion. Yeah, that's all I'm going to say on that. You do you, though, being like I said, don't take my advice too literal, because I'm not a professional trader. I'm not going to tell you guys to take one trade over another. If your bias in how you trade is what looks good for you, then by all means take the trade you like. Don't listen to me, because I could be completely wrong. No one can tell the actual overall structure of the market. And so for the most part, just kind of do what you feel is best for you, what your kind of gut instinct is for the trade. Obviously, once you learn how to read these charts, it'll be a little bit easier to understand moves and stuff like that. But if you feel a pair or a ticker symbol is more bullish than bearish, then enter what you want to enter. I'm not going to tell you differently. I'm just obviously going to give you my opinion on why I feel the chart is looking like that, break it down from a price action standpoint. But obviously the big difference with stocks and Forex is fundamentals can kill you in stocks when compared to Forex. So with Forex, you're not going to have as much. Obviously, you have some market news that can affect your trade, but for the most part, news doesn't really affect overall structure in markets for Forex when compared to stocks. So that's one reason I like trading Forex over stocks is news and kind of crazy shit that happens isn't going to be something that's going to affect Forex as much. All right, peace out, Beanie. All right, but if you guys have questions, go ahead and ask them. Me and Andrew will be here to answer them. So we'll do like 5-10 minutes of questions, and then we'll call it quits. I think you guys should be able to push to talk, if I'm not wrong. Or if it doesn't let you push to talk, just post them in the Forex channel.
Alright, well, if you guys don't have any questions.
Yeah, I think we'll probably just end it here. Me and Andrew should be a little bit more active this week, so I'm probably going to be charting a bunch tonight, and I'll post some pairs for you guys to look at on the Forex side of things. But if you have questions on stocks, just let me know.
Yeah, I'm a lot more free this week.
Yeah, same here. So we will end it there, guys. If you have questions, just post it in the chat. Let us know. Make sure to tag us so we can actually see it. Or just go ahead and shoot us a DM, and we should be able to help you out if we don't see it in the chat. So I think we're good.
Alright, thanks for coming, guys. I'll see you later.
All right, see you guys.